So now let's take a look at the parties typically involved in transaction processing. Obviously, we've got the consumers buying goods and services. We've got merchants accepting credit cards as their form of payment. They can be retail, moto, e-com. They're also the guys that are bearing the PCI burden. They're also the ones that are paying the fees to all the rest of the parties in the processing services chain. We've got ISOs, kind of the sales organization involved here. They're providing the face to the merchant for merchant services, doing client install, service, and support. We've got gateways that are doing authorization and reporting, providing an interface to the back-end processor. We've got the back-end processor, which is primarily the interface to the networks, doing auths and settles. Merchant acquirer, typically the bank in the equation, they're bearing the ultimate risk, and they're generally a silent partner. And obviously, we've got the card networks and the issuers themselves. So if we look at a typical processing flow, you've got on an authorization, the merchant combining the sales data with a card number, pushing that through the flow. Everybody grabs a copy, and then the authorization response flows back up. For settlement, the front end provides an auth file to the back end processor, and the back end pushes that out to the networks. In turn, they receive the settlement and chargeback files, which they pass back on to the merchants. And of course, those chargebacks have more card numbers in them. Now, depending on your agreements, the ISOs and the merchant acquirers, for customer service and risk management reasons, may have access to those card numbers as well. So unfortunately, this is typical processing. Lots of different entities handling transactions, a general lack of accountability because there is so many entities, and lots of copies of the card data. Now, if we look at a front-end only tokenization solution, and keep in mind that many of the token providers are only front ends. On authorizations, with the initial transaction, it's pretty much the same as a traditional transaction flow, except the merchant gets back a token with the response, which is what they store instead of the card number. And on subsequent transactions, they can use that token instead of the card data. Unfortunately, because the front end, the gateway, and the back end systems aren't connected, chargebacks with card data can come back into the merchant system and can, in part at least, defeat the intent of the tokenization to get the card numbers out of the system. And you still have lots of different entities handling the transactions. You tend to have that same lack of accountability, and you still have lots of copies of the data. And obviously, the ISOs and merchant acquirers still get their copy. What EPX has done is we've gathered most of those various processing entities under one roof, and immediately that reduces the number of copies of data necessary, and it also centralizes accountability. For an authorization, the transactions flow a little bit differently in an end-to-end tokenization transaction. The merchant initiates the transaction with sales data, like the dollar amount, and that prompts the gateway to ask for the card number directly from the consumer. With settlement, because the front end and back end are connected in the same system, the chargebacks can be identified with tokens rather than by card number. And the EPX ISO and the merchant acquirer use the tokens, not the card numbers, to service and manage the accounts. So even internally, there's fewer copies of the data. Okay, now we'll look at a few case studies. This was a national retailer, POS retailer in the rental space. They had about 600 or more retail locations. They're processing about $250 million annually over 2.5 million transactions. They weren't PCI compliant. They needed the card number, so if there were late or damaged returns, according to their contract terms, they could run a transaction and collect the damages. In fact, they were handwriting the full card number and expiration date on a 3-copy carbon receipt that they would keep in a little box under the sales counter. As they were attempting to become compliant on their own and realized the liability that those little boxes represented, they shipped out paper shredders to all their locations and destroyed all those paper receipts. Unfortunately, this left them in a situation where they couldn't run those transactions anymore, and so they were suffering approximately $20,000 a day in lost revenue as a result. They also had card numbers passing through their POS software, a typical place for it to be, but it further expanded the scope of PCI. We integrated Firewall, our end-to-end tokenization solution, to work in conjunction with their POS system, using a merchant-friendly hosted payment page to keep the card numbers from entering their POS systems and subsequently reduce their PCI scope. With each transaction response, EPX provides a GUID that they store in case they need to launch any future transactions, and immediately started recovering that lost $20,000 per day revenue. And as an added benefit, we also provided consolidated customized reporting, and it also helped simplify their reconciliation process at the corporate offices. This was a multi-state regional insurance company with about 1,400 agent offices. They too weren't PCI compliant because they didn't take credit cards. They never accepted them because they felt the burden of PCI was just too much to take on, and they felt that taking credit cards in general was just too expensive for their business. So they were very conservative. They didn't want to store card numbers because they felt the risk was just too great. That's their business, so they know. Now, this is coming from an organization that stores just about every other piece of sensitive personal data you could imagine, though, like Social Security numbers, medical records, and so on. They integrated EPX's Firewall end-to-end tokenization solution with their website using the EPX-hosted payment page to reduce PCI scope and prevent card numbers from entering their system. EPX also introduced the pinless debit as a cost-reducing alternative payment type. We also gave them the ability to offer recurring payments without having to store the card numbers using the GUID-based token. Now they're seeing approximately 300,000 transactions and $94 million annual processing through their web portal. And the last case study, this customer was a long-established catalog sales company whose technology was equally long-established. They were smart enough to recognize that they would not be able to meet the PCI requirements by doing business as usual. Their current processor was fining them thousands of dollars a month for not being PCI compliant and wouldn't let them out of their contract. So as part of the conversion process, they tokenized about 250,000 transactions from their previous processing, eliminating the PCI requirements for that data. They integrated their website with EPX's Firewall end-to-end tokenization solution and reduced their PCI scope and prevented card numbers from re-entering their systems for new transactions. To paraphrase them, this conversion allowed them to achieve PCI compliance without burning down their existing data facility. And that's all I've got. Thank you.